Well, so most investors are not designed for you, and most ETFs are not designed for you. Whoever you are, the first thing you need to recognize is you got to cull that list way, way down.
Hello and welcome back to ETF Market Insights. I'm your host, Zayla Saunders, and I am joined by ETF industry pioneer Dave Nadig. Dave is the president and director of research at ETF.com, the host of ETF Zoo podcast, and has over 30 years experience in the ETF space. Just a quick reminder, we are not providing any investment advice today or recommendations. Today is all about education and information. Dave, thank you so much for joining us today.
Thank you for having me. It's a pleasure to be here.
Very happy to have you. So some of our audience may not know who you are. So give us a very quick high-level overview of who Dave Nadig is.
Sure. My current day job title is president and director of research at ETF.com. I do a fairly regular YouTube show called ETF Zoo, which brings together a bunch of the pundits in the space on YouTube. I do another one called Click Beta, where I sit down with Matt Ziegler and Cam Dawson, and we go through actual like economics news and stuff like that. My career has largely been working in the ETF industry, starting back in the early 90s when I was working at what was the progenitor company to what we now think of as BlackRock and iShares. Then it was called Wells Fargo Nico, building ETFs 2 through 16, which were called the Webb's products in the mid 1990s, and have been in and around the ETF industry ever since. I've been CEO here at ETF.com. I was director of research at FactSet Data Systems for a while. I've sort of bounced around.
So 20 plus years in the ETF space, you've seen it all.
Yeah, I think so. I think it's fair to say that I was into ETFs before ETFs existed. I was one of those idiots in like 1991 sitting there reading the SEC report that came out from the 1987 crash, which came up with the idea of the ETF, the sort of basket of stocks that trade on exchange. And, you know, Canada then very quickly got the jump on us and launched the very first ETFs. And then pretty much right after SPY launched, I was in a bunch of meetings with the Amex about what was going to be next. So wasn't there for the very first two, which was Canada and SPY, but jumped in as soon as I could after.
I'm so glad you mentioned that. That is a rumor I like to dispel. People often associate the first ETF being launched in the US.
Yeah, Canada. You guys are always way ahead. You guys are like my entire career has been picking up leavings from the Ontario Securities Commission.
So let's go back to that. What would you say the biggest changes in the industry you've seen since inception have been?
You know, they've all been sort of depth and breadth, right? That's mostly what's happened is, you know, in the beginning we had baskets of first US stocks, and that was really challenging. And then we had baskets of international stocks in the mid 90s, and that was a different kind of really challenging. Honestly, the bridge to fixed income in 2000 was probably a bigger shift than people think about, because now we look at it and we're like, what do you mean bonds? Of course you can stick bonds. It was really operationally challenging back then to figure out how you were going to try to do creation redemption on bond portfolios. We had to come up with the whole cash create system. There's a lot of nuance to it. So throughout from 2000 on, the story has really just been opening access and opening asset classes. So, you know, ETFs now cover virtually every investable asset class in the world, including private credit and private equity. You know, the catastrophe bonds, you name it, is pretty much in an ETF wrapper somewhere in the world, if not in the US. And so as we broaden that, now what we're trying to figure out as an industry is how you recombine all those pieces in more interesting and complicated and easy to charge for ways.
Yeah, that democratization of fixed income, especially for investors, it's remarkable. You're right to think about how bonds were placed in an ETF. It really was a moment of the times. Let's talk about what's really exciting you right now, Dave. We've talked about some new products and things that are coming down the pipeline. I know where you're from in the States, there's a lot of levered ETFs and some funky things going on there. So what's exciting you right now?
Yeah, exciting in terms of like stuff I genuinely am rooting for. You know, there
And we
is
can talk about stuff you're not rooting for as well, too.
Let's start with the stuff that
Start
I'm
with the
happy
good.
about. The Look, the move towards tokenization is going to happen in my lifetime, and I'm excited to be a witness to it. I think what we're seeing in the US and the DTCC and their sort of baby steps towards real tokenized exposure trading. I don't even want to talk about tokenized equities because really this is about just moving risk exposures around. I'm excited for that. I think that the DTCC's approach is sound. I think there is a real chance that we'll get to the point where we're issuing sort of regular old corporate equity shares on chain and extract ourselves from this kind of ridiculous ledgering system we've been on for 100 years. So that's all very exciting. The downside is that the path to get there is just loaded with grifters and criminals. And that's not any particular industry's fault. That's just the nature of big regulatory change, right? That happened with the railroads, happened with the internet. It's happening now around AI. It's going to happen around tokenization too. So that's what I'm less excited about. But it's very hard to be depressed about an industry that has done so much for the average investor. I mean, the playing field is in fact truly level. And now mostly what we're dealing with is the consequences of that leveling.
Yeah, it's interesting in a lot of our conversations, Dave. I don't know if you hear this on your side, but how the retail investor used to be perhaps less sophisticated. And then now you're seeing flows really show that the retail investor is more and more sophisticated, catching up to pensions and sometimes exceeding. Do you see that as well? You're nodding a lot.
Yeah, so look, I don't want to say that the average retail investor is super smart. I think what we can say from the data is that big active ETF traders, i.e. speculators in the market, have gone from being a source of liquidity to being alpha generators. If we look, I just did a study on USO, the biggest oil fund here in the US. And historically, if you looked at the data of when people put money in and take money out, it's like every other thing we say about retail. Oh, they're buying high and selling low, right?
Yeah.
And that has in fact been the case. For the last year, that has not been the case. For the last year, oil traders have been very presciently buying all of the dips at the right time and very presciently selling every time oil rolls over a tiny bit, to the point where the average dollar invested in oil ETFs has actually doubled the headline performance. So oil's up 25%, the average investor's up 50. That's huge, and that's very unusual. There are little pockets you can see like that around the market where you've got the sort of speculative winners thing going on. Net, of course, there's a loser for every winner, right? So you don't expect that somehow this is a class shift. But it is true that ETFs are now alpha vehicles for folks who are being very smart about it. That does not mean it got any easier for retail investors to try to beat the market. All it means is the most sophisticated traders in the world are now using ETFs to express those opinions.
So on that, Dave, what are some trends you think are potentially overhyped right now, or trends maybe that aren't getting enough attention?
Yeah, I think memory stocks and semiconductors, and to some extent the whole AI trade, is all a little over its skis. Not that I'm not a huge believer in the underlying technology. I live in AI 6 hours a day, generally speaking. I think the real CapEx demands are there, so it's not like there's something nefarious going on.
Yeah.
But we're running into the edges of market structure. What happened in DRAM in the US, where we had $26 billion flow into a very narrow memory index fund, which then algorithmically had to show up in South Korea every single morning with giant buy orders, right? I mean, half of DRAM at $26 billion is two stocks. Those two stocks themselves are half of the South Korean market, right? So the pathway towards the craziness we've seen in the Kospi, where it's up 15%, down 15%, circuit breakers in every direction. Now they're talking about banning short selling. Like, that kind of froth is not consumer sentiment. It's baked in, it's structural, right? That is the movement of speculative pressure from the US all the way around the world to Korea. The 8 hours it gets to trade that, and then that shows back up on our market as information to reignite that speculative chain. That's a feature of modern markets that we need to pay a lot of attention to. It does not mean, I think any rational person would say Korea did not, in the last 3 days, become 20% more expensive and then 20% less expensive for a reason. Like that the whole country, in fact, had a giant economic swing. No, this was just raw speculative repricing of the exact same asset, the exact same fundamentals. We're seeing that in SpaceX stock. We're seeing that in a lot of these very high profile stocks. The danger is when that kind of speculative fervor moves from meme stocks to things at the top of the index, you create these flow problems. And that's exactly what we've seen in the memory stock. So I worry about that.
Yeah, it's amazing even just seeing the semiconductor trend in 1 week it's 10x and then the other it's down and you just never know what's happening. But you're right. Are there fundamental changes in that space or is it just excitement in the
And there's
market?
just so many unknowns, right? That's part of the issue is like we just don't know what we don't know about the future.
Okay, so what's underhyped right now?
Sustainable energy, I think, is deeply underhyped.
Interesting. I haven't heard that in a long
We've had
time.
we've had, we know that we have massive electricity demand. That's not controversial right now. All these data center build-outs, and this is a global issue. And as a global issue, you start looking around at which countries are better positioned for these kinds of build-outs. It's easy to look at China. China's probably got the most developed actual electrical infrastructure in the world in terms of excess capacity to drop a gigawatt data center anywhere they want to. That's a real issue. That's part of why Chinese compute is so cheap and they're kicking our butts on inference for AI models. That's a real thing. Germany's now 50% renewables on a daily basis. California has been 50% renewables most of this year. That's real, right? And it's deeply underinvested. Almost all of the ESG and climate change ETFs in the US closed. We closed 18 to 20 of the clean energy ETFs in the US in the last year and a half. So
Yeah.
there's just no attention to it. There's no focus on it. And yet, there'll be corners of it that get hyped. Nuclear right now, people are like, yay, nuclear, which is great. But also like solar and wind and all of these things coming behind it are in fact going to continue to have this incredible ramp of adoption. I think is deeply underinvested.
Yeah, I mean, we see that too here in Canada, kind of that shift down from ESG. It was all the hype, and then now people have bought memory chips instead. But
Yeah.
it'll be interesting to see if it comes back. All things do find their way back. Dave, for somebody who's maybe thinking about getting into an ETF, there's so much choice. How many ETFs do you guys have in the States?
5,000?
Yeah, I think we're around 3, something
Yeah.
like that. So what would you say to investors? Like, how do you even begin to start to look for an ETF that might be the right fit for you?
Well, so most investors are not designed for you. I mean, most ETFs are not designed for you. Whoever you are, the first thing you need to recognize is you got to cull that list way, way down. There are a couple of rules of thumb that a lot of either, advisors or individual investors tend to lean on. Not buying brand new funds is a pretty good one. Like having your own seasoning requirements. You hear rules of thumb like $100 million and 10 million trading a day, whatever it is. I mean, to some extent, that's got to be a personal decision about how big your stash is and how sophisticated you are trading, right? So it may be for a novice investor, you say, hey, I'm not buying any fund that doesn't have $1 billion in it. That's a reasonable thing to do. You're at least not alone, right? You can still make a lot of mistakes, but you're not making them alone. So I think that sort of sets some basic rules of thumb before you start finding the shiny objects can be really helpful. A lot of investors, and I think this is a pro and a con, a lot of investors pick a brand. They'll grab a BMO fund, they'll grab a Fidelity fund, they'll grab an iShares because they like, oh, I can just go to iShares and I can get everything in one place. If I have a problem, I only have to make one phone call. It's not a terrible way to think about it. It's a convenience purchase. And in fact, in most markets, there are giant players with big, broad ETF lineups where you'll do just fine with that, right? You may not get the cheapest fund for every exposure you're trying to get or the most liquid or even the best performing, but you're not going to make a horrible mistake if you get your core asset allocation right. So like limit your universe and focus on the big decisions that are going to matter. Like what percent of your portfolio are you keeping in your home country? That is going to make a bigger difference to your performance than any choice of which provider.
Yeah, what percent towards commodities? Do you even want to go there? Is it, alternative assets?
Right?
Yeah.
If you can't draw the pie chart first, and then if you want to get really sophisticated about, well, okay, my fixed income pie slice looks like this. I want 150 funds in there. I can't help you. Like you can do that, but you can also buy one, and most of the time that's
It
going to be fine.
might be a bit miserable, yeah, especially on the fixed income space. Dave, let's talk about how young investors are changing the industry. And then we can also talk about maybe from your perspective, how you've seen like an older generation adopt to ETFs as well.
Yeah. Let's start with, let's go the other way. Let's start with the old people
Sure.
first, right? So boomers traditionally have been mutual fund buyers. Like the
Yes.
modern personal finance industry
Yeah.
grew out of the 1980s boomers actually having money to invest. And so in the 80s, they threw all their money in Fidelity and Vanguard and, Putnam and all these giant mutual fund companies. That is still very much driving most old people's allocation. More sophisticated boomers, or ones with larger portfolios who have advisors, have in fact shifted towards ETFs. But it is still just sort of this, look at the flows every month. It's like giant there's still S&P 500 mutual funds in the United States that charge 2%. They still have money in them. They were sold to somebody.
Oh,
The
that
average
feels
age of
wrong
one
to
of those
say.
holders, I'm going to guess, is 80, like,
Set it
so
and forget it. They've forgot it.
exactly. They forgot it.
Completely.
They really forgot it.
Yeah.
So like the boomers, to some extent, they either get an advisor and the advisor modernizes their portfolio, which means they end up in ETFs, or they move to Florida and they have $2 million to lose. So they go and they trade it like crazy at Schwab. Right. And those folks increasingly are also adopting ETFs. Very few people are now trying to pick mutual funds anymore. They're picking ETFs, or maybe they're picking individual stocks, but mostly they're picking ETFs. So that's happened on the boomer side. Way on the other side, you've got the degen problem with Zoomers. And I have two Zoomers in my, like, I have two kids that fit that definition. And I've seen with them and with their cohort and just talking to people, that the whole degen gambling thing is legit. Both my kids have expressed their concern over the fact that their friends, are constantly being, inundated with DraftKings ads, et cetera, et
Yeah.
cetera. And I've certainly seen just some of the young men that I know I've watched sort of fall into that pit. And I do think that is particularly a young male thing, the whole sports betting thing. I think it is very gendered. And I think it's net negative. The fact that is now bolting into core investing, there's a pro and a con there. The pro is really sad that you lost a bunch of money betting on the Steelers, but by the way, along the way, maybe you got exposed to keep your money in a money market account as opposed to just in cash, because your gambling app is now trying to be your investment app too, right? With Robinhood or something like that. So from that perspective, speculation and gambling does expose people to money and services around money. And so the people who graduate from gambling often do end up being fairly standard collectible and sensible investors. That's a very thin pro. It's not a big line. The con is obviously enormous, right? The net loss of investable wealth for this whole generation, the despair that is implied by that kind of, misallocation of your own resources, that concerns me. So like that gamblification of everything, I think is just net negative. But it is absolutely changing how we think about how products are delivered and what those products are, right? The leverage that we see in those products is largely targeting younger investors. The income products are largely targeting more of those boomer investors. But even there, these sort of very promissory income things, like I don't need to tell you, you're in Canada, the whole income thing is like a bit of a cult by itself. You guys have it worse than we do down here, right? There are people for whom passive income is a cathedral that they worship at. And so any
Yeah, I
product
couldn't have
that
said it more
feeds that
eloquently
hype.
myself. Yeah. A cathedral they worship. And Dave, I think we talked about this before together, but it is fascinating, especially from my lens, seeing young people be attracted to income portfolios. And traditionally, you think it would be a retiree or someone who needs income, but you're right. It is this trend's not the right
I
word.
think there's two pieces of it. There's one is a very legitimate financial planning piece that they've correctly absorbed, which is that if you are not infinitely wealthy, if you are in an accumulation stage where you have excess, you have savable money, disposable income, there are vastly worse things to do with that than say, go buy the duplex down the street and rent it, right? Like, so that version of passive income at a younger age, like in your 30s, buying a house and flipping it and getting a rental property and going in on a laundromat with your friends, like that kind of core small business owner income generation, passive income thing, that's great. Like I think for a lot of people, that is a fantastic path towards wealth building if they don't have another entrepreneurial path presented to them that's available. So don't have a problem with that. Where I have a problem is the easy button versions of that, where it's like buy this ticker and you get 20% guaranteed, and getting return of capital contributions and screwing up your taxes for the next 10 years. And those products are missold and they are misbought. They just are. I have yet to talk to very many investors who are using them in a way that I think they really get what's going on. And you don't have to listen to me. Just go look at the Reddit for any of these, any of these groups, Yield Max, whatever, and just read the stories. They're all horror stories.
Yeah. And this idea of total return kind of seems to get lost and people don't want to engage with that, but we can have a whole episode on that. Dave, let's talk about your innovation really in the technology space. ETF.com, you now host a podcast. Like, how has the innovation of technology really catapulted your business, and how are things changing digitally for you now?
Yeah. So, I've been in some version of what I would just call advertising supported media for the last 20-ish years.
You were going to be a
Before that, I
screenwriter,
was large.
weren't you?
Sorry, what?
You were going to be a screenwriter way back when.
Way
Those
back
were
when
your
I started,
dreams,
like
way
in the
before.
80s, I was in Hollywood working in TV. For most of the 90s, I was running money in some capacity, whether I was helping build products, or in the late 90s, I was actually sitting on a desk running funds. Since then, since the 90s, I've been on the other side, where I've been either a pundit or a media personality or a writer or running businesses that do that, largely being paid the way most media gets paid, which is some issuer wants to buy an ad. We produce content which gets eyeballs, so we're selling the eyeball to the issuer. That's how all advertising supported media has generally worked forever. That business is completely changed, right? So the current version of that change is we've gone from 15 years where search engine optimization is what drove media to a world where search engine optimization is now utterly irrelevant because nobody searches for anything anymore. So in the matter of 2 years, we went from a business where you were selling eyeballs based on clicks, based on engagement, all the social media farming stuff. That was the engine and the flywheel, which worked very nicely, to nobody cares about that anymore. What they now want is proprietary. They want proprietary data. They want proprietary insights. They want something they can't get out of the LLM to feed their LLM, right? That's the input now to their decision-making process, which is happening with an AI. So that shift is huge. And how a business like ETF.com sort of remonetizes in that world is challenging. I think the cut to the chase, the answer is connection. The part that an LLM can't do is actually introduce us together. Right? It can't find Zayla and say, Zayla and Dave, they need to talk and they should talk about this, because they don't know, like that. That's not what it does. So I think we've become more and more and more in the connections business, trying to highlight the actual human beings at issuers. Like one of our most popular shows is called Behind the Ticker, where a guy named Brad Roth just sits here and grills people about, why did you launch this fund? Like this literally is just like, okay, here's a ticker. Why? And then we dig into it and you get to know the people. Right.
Cool.
And I think that helps way more than another fact sheet or another pile of data. So I think that's the big shift. How you monetize that's always challenging. We do a lot with conferences, that helps. We do a lot with video, that helps. But those are all very human, right? We're getting out of this business of just producing text that then people click on, which makes me sad because fundamentally I'm a writer. But I think that's the giant shift right now. From the shift that happened in the 90s, which is we went from a paper world to an online world, right? But I mean, in the beginning, it was about Barron's and Forbes. It wasn't about .com anything.
Yeah, that's kind of the special thing to me about the finance industry is it started as a people business, and it still is, right? Like, having a meeting with an advisor, or whether you're doing it yourself, there is still that sense of connection, and people want to talk to one another, whether it's about their investment portfolio or the markets or why an ETF got launched.
Yeah. And, I think social media replaced that for a lot of people. Certainly the heyday of FinTwit, financial Twitter, which I would sort of say was 2015 to 2019, like in that window, maybe a little bit earlier. people took their very non-human business of quant trading and they brought all of that into Twitter and they yelled at each other about it, which they still do. Now it's more economics than trading than it used to be. That feels like this expression of I need the human connection to this inhuman activity of chasing numbers on the screen. It's interesting to me how that will change because I think we are heading for a slightly post-social media world. I certainly see that backlash in Zoomers,
Huh.
that folks just don't want to be sitting there on a social media feed all day long. And so if that is a real thing, it's not just my wishful thinking, that has some real implications. Where does the humanity come back in that, right? And I have ideas. I think we're going to see the rise of things like investment clubs, just like we've seen the re-rise of book clubs, as people try to socialize around this
Yeah,
activity.
that's really interesting. So you have two children that are Zoomers, and you can see that stepping away from social media. You're saying that's interesting. I haven't seen that yet.
Yeah, I think there's an AI backlash certainly, that is part of it. I've had, plenty of here's a conversation I hear all the time. I just got off a call with somebody where this happened, where somebody was saying they were talking to their mom and their mom was showing them, "Oh, look what I saw on the internet." And it was AI. And then the whole conversation becomes about avoiding getting duped into thinking
Oh
something is
no.
not AI. I think that is a cultural zeitgeist. I don't think it's anti-AI. I think it's divisive AI, where AI gets to go live in its bucket, and then we very clearly label the rest of the world as not AI.
Mm.
That I think is very, very prominent. I think that's no getting around that. I think that is probably the cultural shift of the next decade, is how we respond to these artificial creations. And I think that the decoupling from broad social media towards local social media, meaning my specific group of friends, I see that in a lot of places, whether it's, if you talk to my kids right now, they're much less interested in what's going on in Instagram writ large, and they're much more interested in what's going on in the group chat, right?
Huh.
They're 45 friends in WhatsApp, right? They've recreated their own social media.
Their own
And I've seen
community.
that happen in my own world too. Gen X has definitely done this. Like Gen X has moved entirely to Reddit and Slack.
Huh. That's fascinating. Okay, Dave, we're almost at the end of our interview. So, if there was anything that you could leave our audience with around the ETF space or things that you're really excited or words of wisdom, what would they be?
Trust but verify. Like the ETF industry is a data intensive industry. If you're going to get into the space and start playing around, you're going to be looking at portfolio holdings and time series returns and all that kind of stuff. Don't believe any of it. The data quality in this industry, despite I've spent my whole career
I
trying to
was
make it
gonna say.
better, it's not great. And it gets worse by the day because the issuers are trying to get away with more and more. And so they're promising more and more. So you've really got to do your homework at a level that I don't think you've had to for most of my career. I think it becomes more and more important to do more homework the bigger this industry gets. So that's my main advice is, be careful of that. And the other is I think we live in a fairly black hat world when it comes to investing. We are certainly in the US, we're in a massively deregulatory environment. We've gutted our regulators. They can't even have meetings because they're below quorums. And we're pardoning financial crime by the day. So we've created this incredibly bizarre set of moral hazard where we said we're not going to regulate it. And then when you break the rules, we're going to pardon it. And it's very specifically financial fraud that's there. So anything that seems too good to be true, you should be asking yourself, how could I be getting taken advantage of, regardless of whether it's a giant brand that you would normally trust.
Yeah. Words of wisdom. Well, thank you very much, Dave, for joining us. And I look
Thanks for
forward to
having me.
seeing you
No,
in
this was
person.
fun.
Yeah. Appreciate your time, as always. All right. That's it, everybody. Thank you so much for joining us today on ETF Market Insights. And we'll see you next week for a new episode. Bye for now.